Hey everybody, Vince Lewis, Vice President of Sales at Partners MGU, welcoming you to the latest edition of the Partners Podcast. On this edition of the podcast, I had the privilege of chatting with a name that's pretty well known in self-funded circles, Adam Russo, the co-founder and Chief Executive Officer of the Phia Group. Our discussion covered a wide range of subjects relevant to our industry. In fact, because of the wealth of knowledge he has, we talked about so much that we're releasing this edition in 4 episodes. The first episode is titled The Biggest Differences in Stop Loss. So when I was preparing for this episode, I was reminded of a meeting I had with a prospective producer a couple of years ago. I questioned him, and when I questioned him on the stop loss markets, he explained that they had no allegiance to any one carrier, as they felt that stop loss was quote unquote a commodity product. You can change carriers anytime with no distinct difference between one carrier, one stop loss provider, and another. I don't know if I was more shocked by the comment itself or this particular broker's ignorance. But one thing we do know is that not all stop loss providers are the same. And the biggest difference more often than not is in the stop loss policy itself. For example, is the plan mirroring provisions in the policy actually plan mirroring at all? Or how is experimental and investigational treatment explained? What about potential gray areas like reference-based pricing and vendor fees? More often than not, as you will know, these challenges don't even really manifest themselves until there's an actual claim. In this segment, I'll talk about what I feel is the big lie concerning stop loss. Adam will comment on the biggest mistake that brokers and consultants make in reviewing and comparing stop loss policies. Want to guess what the biggest challenge is? When he told me, I found it to be actually quite shocking, and I'll leave that for the podcast for you guys to listen to. But very rarely does this thing actually happen when folks review their stop loss policies. Anyway, I hope you enjoy this. To listen to the full conversation, please click on the link in the description. And tune in next week for our next episode on how COVID-19 impacts stop loss claims. We'll see you again soon. Please feel free to comment. We'd love to hear what you all have to say. Thanks.
Hey, hello everybody out there. Welcome to another edition of the Partners MGU podcast. Today we have a super special guest. I'm super pumped, super excited. The man, the legend, Adam Russo of the Phia Group is here to join us. This was a major get for us. So Adam, welcome to the program. Thanks for joining us, man. It's an honor.
I'm honored to be here, especially your organization. You guys have been a great organization to work with over all these years. And I'm a loyal person. I believe in growing this industry, and I believe in doing everything I can to help my friends, partners in the industry succeed and thrive, and you're one of them. So I'm glad to be here.
There are probably like 4 main issues I want to cover with you. Primarily, one is stop loss contracts.
Yep. What's a stop loss contract?
Yeah, well, that's a good question, right? This day and age. I mean, so that'd be the first thing. So, I mean, in politics, everyone wants to talk about what's known as the big lie, right? I mean, but we're not going to talk about politics today.
No, talk about the big lie. Bring up the big lie with stop loss. Yeah.
But there is a big lie as it relates to stop loss insurance. And that to me is that all policies, all stop loss providers are created equal. We're just this commoditized product that everybody can just interchangeably shift in and shift out and that sort of thing. But there really is a difference, especially as it comes to contracts. So I'm kind of curious in what you guys do at Phia. What do you see as the biggest challenges or biggest differences in stop loss contracts, and in terms of major areas of difference, I guess, and what should plan sponsors, brokers be looking out for when they review contracts, if they review contracts at all?
Biggest challenge is getting people to read them. Read the policy.
Like I said.
I mean, that's it. I mean, put it this way, Vince. One day when I grow up, right, when I become a big guy, right, when I finally make it to the big top, the major leagues, I'm gonna start my own stop loss company, and it's gonna be called Phia Stop Loss. Okay.
All right.
And what I'm gonna do is I'm gonna have the cheapest premiums on earth. So if everyone else is 100,000, 150, 200, 300, mine will be 20 grand. Okay. It's gonna be so cheap, everyone's gonna buy it. But here's the thing. Instead of a 10-page policy, it's going to be a 1-page policy, or maybe 2. Okay. And what I'm going to do on page 2, not on page 1, they might read page 1 by accident, but on page 2, I'm going to have one exclusion. and I'm going to highlight it. In yellow. I'm going to put like glitter on it. I'm going to make it a 30 font. I'm going to bold it. And it's going to say, we will never reimburse a claim. And I will sell so many policies because people don't read them. They just look at the price. And the bottom line fact, folks, is this. I have seen, my company, Phia, has seen every type of stop loss policy there is. If you're not realizing that there's exclusion provisions in there, there is language in there that literally would make it that you, as the plan, have to pay the claim based on the terms of your plan doc. But the stop loss carrier does not have to reimburse you. They don't have to reimburse at all. They specifically say in that situation, they won't reimburse. Now, that might be fine for you, but at least you would know what that risk is. Most people assume that when they buy a stop loss policy, if they pay it and it's over spec, it gets reimbursed. And the number of calls, I would say, and I'm putting guns in my head, I'm guessing here, but I would say at least 20, we deal with at least 20 situations a week that deal with this.
Wow.
And even those companies that say we mirror the plan, we've seen some organizations use mirroring as a way to not reimburse a claim too. Because what happens is they'll say is, well, the plan isn't following the terms of the plan. Hence, we're not going to reimburse the claim. So I would say you have to read the policy, but I would say almost as important is understand the behavior of the stop loss carrier that you're working with or the MGU that you're working with. Do they have this attitude in their claim shop of deny first? Right? That's the thing. So you want to work with the right organization, and you guys are one of those organizations. I mean, that's the bottom line. I would not be doing this call with you guys if I thought that your policy is one that's ruining the self-funded industry. But there are stop loss policies out there that because they're so bad and because they're not being reimbursed, and I get it, the stop loss carrier does not have to reimburse. But what happens is this, Vince, the minute one employer that's self-funded for the first time, they got 300 lives. The minute they have a $300,000 claim where they're thinking their spec is 50 and they're not being reimbursed 250,000, guess what they're doing? They're never self-funded again. They're going back to fully insured. So all the amazing things that we've done over the past 20 years just go away because we're not looking at this as a way to help our industry as a whole. It's a few bad apples out there that are ruining it for the rest of us. So all I would say to you listeners out there, read your stop loss policies. And if your exclusion section is more than a page, I've seen something like 4 pages, maybe don't sign it. And if you see a stop loss policy premium that's, 30%, 40% cheaper than all the other ones, there might be a reason for that too.
Right. Ask questions.
It's not just the price. You got to look at, will they actually reimburse? Is it a solid organization? And are they truly a partner or are they a vendor?
To your point, each policy has different provisions, different exclusions, different everything. So to your point, the broker or the plan sponsor has to review the policy, and each one is going to stand out differently than another. If they read it, then they'll know, right? They're educated.
I'm guessing that 10% of them are read. I really mean that. Because and I'm sorry if we're going too far on this point.
No.
We've even had situations where we have told a TPA or a broker, listen, my friend, here's the language in the policy, right? You see this provision? If they wanted to, they could actually make an argument to never reimburse any claim if they just chose not to. So you better be careful, especially near the end of that stop loss year. If they decide to go somewhere else, they're not going to pay that claim back. So we advise them. Oh, and also, Vince, by the way, guess what else? By the way, right now at our company, I'm just making this part up, but this actually happens. Right now, that same carrier, that same stop loss carrier, is doing what I'm telling you to 10 other TPAs across the country, and they're being sued by 4 of them. Wow. Are you really sure you want to partner with these guys?
Wow.
And even after all that, Vince, they still do it. And why? It's cheap.